What's up, guys? Welcome back to another episode of the BlockHash podcast, your number one resource for all that is happening across the emerging tech space. Be sure to like, comment, and subscribe wherever you like to listen to or watch the show. Today, I'm joined by Bundeep, CEO of Fineqia, a digital asset business that builds and targets investments in early and growth stage technology companies. We're going to talk about a few different topics today, especially in relation to ETPs like ETNs and ETFs, some differences there, and what Fineqia is doing as a platform here in the ever-growing Web3 space. Bundeep, welcome to the show. It's a pleasure to have you on today. How you doing?
Thank you. No, great to be on. Beautiful day here in Paris. Just attended the Proof of Talk conference, so I'm chilling out here for a few days before I head back to Canada. But always a pleasure to be here. So thank you.
Likewise, pleasure's all mine. Hope you're enjoying Proof of Talk. I heard that it's going pretty well. I know a number of people that are there as well, and it looks like a beautiful day as well. To get things underway, I'm sure people would love to learn a little bit more about yourself and your background. If you don't mind sharing a bit about maybe what your story's kind of been like that kind of led into Web3. Everyone's kind of got an interesting story given the youth of this space. And then also what kind of sparked your curiosity to be a part of it.
Yeah, I think everyone has their own kind of journey. I have a triangulation of events that I think brought me here. So the very first introduction to Bitcoin was back in 2013. There's a friend of mine who had a startup in California. He was from Germany. He had moved to Palo Alto, and he was creating effectively a way of having digital title. So you have title to underlying assets, and the title could be a fungibly traded instrument. The company was called Navio, Navio, and it was kind of like pre-tokenization for what we now refer as tokenization. So it was waiting for the blockchain and the transfer of value. So he was in London. He got some friends together at a French restaurant in East London, a very historic one, and said, "Look, the only thing I want you guys to do tonight when you go back home is buy Bitcoin." The only crypto at the time was, of course, Bitcoin. And we were all a bit, let's say merry, a little inebriated, of course, from a nice French culinary experience and the wine that goes with it. But we said, okay, look, great. And not all of us did, but most of us at some point, either that night or soon after, managed to get it. It wasn't easy to get crypto back then. There weren't like exchanges like we have today. So it was a bit more of an arduous task, but we got it. And of course, as it went up, many of us also sold them because you're like, great, this has gone up 10x or 20x. Great. You don't see that in the stock market. And we did think it'll go up, but the way it's gone up to the current levels, I think few of us predicted back in 2013. So, some held on to some, but, so it was the first foray into Bitcoin and therefore the crypto world. The second, I think, was a belief while reading about it and saying, look, this is a way to re-engineer the world's financial systems and have a way of transferring value that's digitally native. Because most times when you're doing something, it's an offline system that's moving online. You do e-commerce, you take your credit card out. That's not the same thing as just transferring value seamlessly like you do from wallet to wallet in the crypto world. So it's just so natively digital for value transfer that it was appealing. And of course, it creates a new financial system that's outside of political considerations and state government agendas. This is just mathematically tuned. Growing up in India, there's always been a suspicion that the world's financial system and the world's currency rates are a bit exploitative because they preserve pricing power for more mature economies, and they'll value the same work differently. So if you're coding a line, it's worth 10 cents in one country and $1 in the other just because the currency is different. Never mind the fact that you have the same output. Whereas when in a system that's impervious to it, you're basically valuing the work for what it is, irrespective of where they are. And that's the whole thesis behind decentralization. And the currency that's used for that is a cryptocurrency, which again is not bound by a national bank in a fiat state. So to me, that was the second appeal. And the third thing is I set up a company in the UK, which is a non-crypto company. So having been introduced to crypto in 2013, I kind of made a conscious decision in 2015 to build a fintech company, or more specifically an insurtech firm. It's called Premfina, which is a sort of abbreviated version of two words, premium and finance. So it's the financing of insurance premiums. So we don't sell insurance, but whenever someone buys insurance and opts to pay monthly and not the entire amount up front, there's usually a financing company involved in between that is prepaying the insurance company the entire amount upfront as a lump sum payment and collecting the equivalent over monthly installments with a margin. So it makes insurance more affordable for people. It's now, a bite-sized purchase price as opposed to a big ticket they have to put out for buying insurance. And that could be $1 million for a property, or, $5,000 or $2,000 for car insurance. But making it more affordable is appealing to the end consumer, the end customer. If it's a commercial enterprise, of course, brokers sell more because now more insurance sells, and insurance companies like it because they're selling more insurance and underwriting more. So everyone benefits, everyone's a party. And the beauty of the system is that our counterparty risk is basically an insurance company, because we're not advancing money to an end customer, we're advancing money to AXA, Aviva, AIG. And if we don't get the repayment done on time, and after a few reminders, of course, we can cancel the insurance. Insurance, as you know, is a prepaid product, but if you ever buy and sell a car, you cancel the insurance when you sell your car. And at that point, you trigger a pro rata refund. You get a balance back that you haven't utilized. So our risk is super low because we are due to get a refund, and the refund is from the counterparty of a or highly rated insurance company. So it makes it very, very credible as a lending platform. So when I built that, and we started accumulating loan volumes of now, about $1 billion in loan volume this year, I was like, you know what? The crypto world is looking at high quality, real world assets. And those assets are uncorrelated with crypto, and they are generally yield bearing with low counterparty risk. Well, here I'm sitting on insurance financing with low risk because counterparty of insurance company, pro rata refund upon cancellation of the premium, and a decent and healthy yield. So how can I take this into the crypto world? And that led to discussions about tokenizing it. The tokenization then lent itself to ultimately, our project I'm working on with the co-founder of Tether to set up a new stablecoin that capitalizes on these growing pool of yield-bearing RWAs, and then we bring some new innovation to the system, which we can get to over the course of this conversation.
Yeah, these yield-bearing opportunities, RWAs, tokenization, it's definitely grown in popularity over like the last year or two. And I imagine that's been a big talking point as well at Proof of Talk. And I'm going to head out to permissionless, like I mentioned, in about a week and a half. And I know that's also going to be a very central theme. It seems like this is a big entry point as well for a lot of institutional players, asset managers. Um, Anyone that's looking to invest in the space and have something a little bit more stable as an investment, um, especially around stable coins as well. It's definitely interesting how the space is kind of shifting from where it started, all the way back. And I got into Bitcoin around like 2013 as well too. So I remember like downloading the Bitcoin client onto my computer just so I could hold Bitcoin in a native wallet. And like where it's at today is like you have even DeFi on like Bitcoin. Like it's evolved in so many different interesting and fun ways. So it's been quite a journey for sure. With Fineqia, what would you say maybe is like your guys' core mission or primary directive essentially? Like in terms of the problems that you guys are aiming to solve, is that, around investor exposure to a lot of these different early stage deals or crypto opportunities, or how would you
Yeah.
summarize?
No, great question. So, one indication of what we're about is our name. So Fineqia is sort of an abridged version of financial equality. So it's providing democratizing access to financial products. So we want to bring institutional quality investment opportunities to everyday persons, and that's what the whole thesis is behind Fineqia. Realistically, what that means now is introducing digital assets, crypto assets, and blockchain-based opportunities to the vast majority of investors who are still not crypto. I would say not necessarily crypto friendly. There's obviously people who are not crypto friendly, but it's not crypto educated. And for us, we've become a lens for them to look into the crypto world, and hopefully a bit of a filter for them to see what's real and what's not, and then look at opportunities because we are highly networked and knowledgeable in the space, and we actively do things where we have our own skin in the game. So there's an endorsement value for what we do. So it really is bridging the traditional finance world to the non-digital finance crypto world. And to put that in context, right? One of the big themes in proof of talk, aside from uh, tokenization and RWAs, I'd say the two themes were stablecoins and ETFs that are now yield bearing potentially in the US. If I look at those two, tokenization and the stable coins go hand in hand because you can only price tokens in a stable currency. You can tokenize whatever you want. But if you want to price a bridge or a private credit fund or a money market fund or other real estate, not just a bridge, but an office building or whatever, maybe not Eiffel Tower, but some tower out there that is not national heritage, right? And you tokenize it, you can't price that in Bitcoin or Ethereum because they're just too volatile. So you need stable coins. And therefore, one is reinforcing and feeding the other in terms of utility and adoption. Stable coins are today worth 250 to 300 billion in market cap, right? If you look at Tether, Circle, etc. The coins themselves, the tokens. The total usage of fiat currencies and equivalent cash equivalents, like money market funds, for example, on deposit or in usage and commerce is about 120, 125 trillion. So even let's say 300 billion of stablecoin usage is like 0.003. It's like 3/1000% of the non-stablecoin fiat currency and cash market. So we have a long way to go, right? Even to get like 1%, which will massively amplify the current stablecoin market, is still only 1% of this traditional finance. So there's a lot of people sitting in the traditional finance world, whether they're Western European or Eastern European or North American, that are highly educated with access to it, or in places where some parts of Africa or Asia where the digital divide exists, and this represents a way for them to hold on to their value by a cryptocurrency vis-a-vis a local national currency that's devaluing. The imperatives are there for both categories, and that's what's really exciting, and that's what Fineqia is about, is getting financial access uniform and making it much more democratic in terms of digital asset access.
Got it. When you guys are looking at some of these different opportunities in the space, and there's so much innovation going on and so much being developed all the time, and there's new stuff every single day, it feels like, do you guys have like a vetting process to go about looking at what things are more legit than others, or that have the regulatory approvals, or that are meeting certain standards? What's that process kind of go into for you guys in terms of vetting?
So we want to look at things primarily that are innovative, and the innovation has the parameters of being commercially viable and attractive and legally compliant. So we definitely have innovation as our theme, because we don't want to be another Me Too and just replicate what else is out there. And within that compliance framework, it's knowing who you're dealing with. So when we look at opportunities to invest in, it's not just what protocol is being built, what project is being undertaken, but who are the people behind it? Who are the actors there? We need to know them, because that's where things fall, through the cracks. And similarly, if we're dealing with a investment product or instrument like we do ETFs, and we are dealing with counterparties, it's like, who's the originator of an asset behind it? It's not just the asset quality, but the value of the originator. So you can have a money market fund by BlackRock, you have a money market from some other unknown party. Which one will you take? Even if on surface they both are equal yield and both money markets, you'll take the one that has a brand and pedigree. So it's understanding the people and the brand and the entities behind it. And ultimately, it'll come down to, even within them, the people. So it's always a big imperative for us, as long as it's innovative, and therefore it means a commercially attractive proposition and not just the Me Too. So that's our kind of triangulation of different criteria.
And I know you guys have an ETN, and I want to get to that in a second. But I think a good place to start is maybe what the difference is in some of these exchange traded products, specifically ETFs, which I think a lot of people are familiar with, at least in the US, where I'm from, and also ETNs, exchange traded notes. Like, what are the main differences there, or the benefits of each one?
Yeah. So I mean, in principle, they're very, very similar, and ETFs have had a wide dissemination and adoption in the world, and that's where you're all familiar with it. So if I break that down, that's an exchange traded fund. So a fund will hold underlying investments, and most funds or a lot of funds rather, are privately held and closed, which means once you invest, you're locked in until the fund gives its returns in the form of distributions from the underlying investments when they exit. If you want to get a liquid fund, the only way to do that is to exchange list it, and you can sell your interest in the fund to other buyers who are interested in it. So an exchange traded fund really is a fund with underlying investments that's liquid because its parent company is tradable on the stock exchange, and you're buying stocks like you're buying Microsoft or MicroStrategy. It's the same idea. When you take that structure to Europe, there are a few directives, such as the Alternative Investment Fund Management Directive, which stipulate that if you have a fund by its nature has to have a diversified portfolio of investments. That's why you're attracting investors saying, I'm de-risking it for you because we are have an inbuilt portfolio theory that we've adopted. So you invest in the fund, and by the nature of the fund, you're getting de-risked because you get a diversified portfolio. If you want to do a Bitcoin ETF in Europe, well, there's no diversity across different assets. You only have one asset type, which is Bitcoin or Ethereum or Cardano or Solana, what have you. So if you want to be a fund, you can't be a one investment only fund because that's, by definition contradicts each other. So what you do is you set up it you set up a vehicle that holds the underlying Bitcoin or Solana or Sui, whatever the crypto is, as a collateral, not as an investment. So think of you as borrowing against it. You pledge your collateral and you borrow. So that vehicle or a special purpose vehicle, an SPV, will issue loan notes against it. So your investors are actually holders of debt through a debt security called a loan note, which is collateralized by the crypto. And therefore, it's an exchange-traded note as opposed to an exchange-traded fund. So the universe is more like 97% ETFs and 3% ETNs. And the combination of the two is part of what is a larger umbrella category called ETPs, or exchange-traded products, which encompass both ETFs and ETNs. So it's a way structurally around that whole issue, but you're creating a debt security rather than equity security, and you have note holders rather than shareholders. But ultimately, you're getting exposure to crypto through that vehicle as a listed instrument.
Okay. Are they more common and popular in other jurisdictions, like in Europe, for example? Because I know in the US they're not quite as common. Maybe that'll change. But I'm also kind of curious, like the different jurisdictions here, if maybe there's more headway in places like Europe versus the US on some of the stuff.
So in the US, there's a few things that have led to the crypto-backed ETPs being less, let's say, proliferate less. So until the Trump administration came along, there was just a lot of regulatory um, pressure against it, and there's just clampdowns and people trying to do anything. You saw like Winklevoss apply and then reapply, BlackRock apply, then reapply. That changed, of course, um, when BTC ETFs got approved, and then soon after that, Ethereum got approved, and then you've seen, $50-60 billion flow into BTC and ETFs in the US. I would say that despite that, the ETF industry in the US is generation one, i.e., you're just buying and holding the two predominant digital assets, which are BTC and ETH, and you can't do anything with them. What can you do with if you hold BTC or ETH or Solana, Sui? You get yield from them. You can deploy them in staking pools and get yield, or you can have them on DeFi protocols where they use for like collateral-based lending or yield farming, and you generate yield from that too. So Europe is one step ahead of the US insofar as they allow for more coins, not just BTC and ETH, but Solana, Sui, Cardano, Polkadot, you name it. There's a whole bunch of Ripple. There's a whole bunch of coins that are approved, and it allows for more activities, i.e., staking and beyond. US is just getting to that without they're about to approve Solana and Ripple and Cardano and various coins and allow for staking. The problem in the US is that when you have a entity that deploys more than a certain percentage of the underlying assets in what's stated to be a lending activity, which would be like staking or DeFi, then it becomes an investment company and not a holding company. And investment companies can't. Then you have a different criteria of regulation and regulatory burdens, different license requirement. So there's a cap on how much can be deployed for staking purposes, even when it is approved. And right now, it's not approved anyways. They're about to approve that. Europe, and by the way, as Fineqia, have a subsidiary in Europe, which has probably got, and I don't mean this in a way that's kind of flatter, but we probably have the widest possible permissions on the planet when it comes to approvals. So we have approvals to hold any asset that's digitized, i.e. has a token, and the token is tradable, on exchanges on the crypto world, like Texas indexes. But more importantly, we can deploy the coins on any activity for yield. So we can do staking, liquid staking, restaking. We can put them in DeFi protocols where they use for lending, borrowing, liquidity provisioning, or collateral provisioning, yield farming, the whole works. And when I was watching and listening to the guys at Proof of Talk talking about how, there's still how cumbersome it is to get past the U.S. regulatory approvals, and while there's efforts there, it's still got a long way to go. Maybe they'll approve staking. I'm like, we can do everything in Europe right now. If we had the same permissions in the U.S. market, which is much bigger than the European market, and of course goes to like small towns and big towns alike, this would be a gangbuster, right? So I think what U.S. has done, I don't think intentionally, but by virtue of having a less friendly regulator now that's now being now replaced with a more friendly regulator and government, is they've sort of allowed for incubation of ideas to take place in other jurisdictions like Europe, like Hong Kong, like Australia, like the UK. Europe is probably still the leader, but it doesn't take away from innovative products that have come up in Hong Kong or Japan or Brazil or Australia. And I think now they'll borrow from that and come up with some ways of dealing with innovative new products. I still don't know how they get past the 40% cap that's there, but that's to be TBD. And we want to take that arbitrage that exists today to come out with more products. So we came up with a product in January this year, which was the first product to deploy underlying coins in DeFi. It's a Cardano-based product. The ticker is YADA, YADA, for yield on ADA. And basically, that's a product that will be sort of an icebreaker for us to get more products out. We're looking at yield-bearing Bitcoin product, for example, that we should have out in a few weeks. We have other products planned for meme coins, for Solana, for Sui, etc., that we want to get out because it is the way the world's going when it comes to adoption of crypto assets in the non-crypto world, i.e. TradFi. And we create a regulated listed instrument tradable on major European exchanges that also gives you yield no matter which way the market goes. And for us, that's the innovation we're bringing. That's also, to my point earlier, innovative, legal, commercial. And we're doing it with credible parties.
Do you imagine this gap will kind of close between Europe and some of the rest of the world in the US? It's been kind of weird. Obviously, the last 3, 4, 5 years, especially in the US, it's been so regulatory heavy in terms of the oversight and what they choose to allow, and they pretty much were allowing a very limited subset of just Bitcoin ETFs at first, but even before that, like it felt very hostile, and everyone was jumping ship and wanting to run to Hong Kong and Singapore and Dubai and in Europe to continue innovating in this space. And then it feels like a full 180 over the last 9 months or so. SEC has wiped the slate clean and said DeFi is going to be exempt to all these rules for the time being. And the stablecoin bill, the Genius Act, I think is passing right now in the Senate and in Congress in the US. So people are going to start touching stablecoins a little bit more and some of these yield bearing products. Do you imagine that gap closing quite quickly, or does Europe have quite a big first step there?
I think that there's going to be a catch up for sure, and Europe will continue to be like innovation friendly. Especially you've got something called the marketing crypto assets regime, MiCA, which allows for at least regulatory certainty. The U.S. issue has been around enforcement as the way for regulation, as opposed to providing guidelines. And as you correctly point out, the Stable Act and the Genius Acts are designed to take away some of that uncertainty and put some parameters in place that people can work with. Will there be a catch-up? Yes, but there is this restriction in the U.S. that I mentioned before, where you have this cap of 40% that's deployable for interest-bearing activities. Because once you get interest on that underlying asset, it becomes a security, and there's a cap on how much you can hold as an overall asset portfolio that's interest-bearing as a security, which I think is 40%. So you can only get yield on that, not 99%, which you can in Europe, right? Now, having said that, the U.S. Administration is now increasingly, like you mentioned, for DeFi, they're waiving things. They're looking at things past it because some of these rules or acts of legislation are outdated. They don't fit the bill. Like nobody thought of on-chain activities back then, right? So that I think is it's still an arbitrage, if you may, regulatory wise, or a gap, if we want to look at it. There'll be some catching up, but until there's some structural changes made in the US for reasons that I just pointed out on this 40 threshold, it'll be harder. But they will, because you look at the market, right? So if I look at the, like, let's say, month of May, the total value of all ETPs, that's ETFs and ETNs that are crypto backed, hit about $170 billion worth, right? And that is almost 20% higher than what it was at the end of the previous month, i.e., the end of April. That's a massive rise in 1 month, right? And the underlying crypto assets, if you look at the wider digital asset crypto market that you will go and see on like a CoinMarketCap, was about $3.4 trillion. And that rose from about 3.05 the previous month in April. So that's about 11% increase. So the crypto markets increased 11%. The ETFs and ETNs that are backed by crypto increased almost 20%. So there's like a 70% plus premium in terms of the ETF versus or ETPs versus the underlying crypto assets. So as long as you see that growth and you see this premium, I think that any regulator, any government will be, let's say, less than smart to ignore that trend and make barriers continue to exist or create new ones. And the U.S. is still like the biggest economy, and once they come up with rule sets, other places will follow.
Yeah, I agree. And I think this is where, when you have innovation in finance meeting traditional finance, and when you have a system in the US that's worked for a long time, but it's very archaic when you put it up against, Web3 and stable coins and yield bearing assets and all the creative things that we're talking about that Europe is able to do, and those different thresholds, one being 40%, one being 99%, that definitely creates some hoops to jump through over time. But we'll see. I imagine the U.S. will continue maybe shaping things up to match this new industry going forward, but there's a lot that needs to be done for sure.
And then you also need the various service providers, right? So to give you an example, when we put out the Cardano one, we got regulatory permissions relatively easily. And we got it from Liechtenstein, which is a very enlightened regulator. And our prospectus is what's called EU Passport Directive compliance. So we can effectively, once approved in one jurisdiction, you can offer it in any of the 27 European Union countries through what's called a passport directive. So you really passport your permissions and approvals for your prospectus across the EU. And that we thought will be the hardest thing to do. That actually turned to be less of a challenge compared with getting market makers on board, because then they look at where the coin's deployed, which DeFi protocols they are, what's the depth, what's the volume, who are the actors behind it, to your point earlier about working with credible counterparties, and who the directors are. So it was a fairly arduous KYC process for the companies that provide infrastructure support, like market makers, like authorized participants. And we've got, probably the Rolls Royce of infrastructure built. We have FTSE Russell, which is a subsidiary of the London Stock Exchange Group, as our index providers. Nobody can question the integrity of our benchmark index and the data. We have flow traders and Lang & Schwartz as our authorized participant and market makers. And with all that, we then still struggle to get approvals from stock exchanges, because they like the idea of it and they love the fact that this was innovative, with DeFi being the underlying deployment of the crypto coins. But they didn't say no. They also didn't say yes right away. And it took us a long time, even though we had AUM from people who wanted to put into that product. I'm like, look, you will make money on this. This is a crypto-backed product, and the world's going to go there. If you don't approve it now, you'll approve it in 2 years. Why not take the lead? And it took us a while. Like, we still didn't get some of the bigger exchanges to list it, but we were lucky to get the Vienna Stock Exchange, which is now the third largest home of crypto-backed ETPs in Europe, to list us. And in some European jurisdictions, or rather with some European exchanges, if you're approved with one major exchange, they automatically accept you for listing on theirs. So we've now been able to go from there to Stuttgart, and we're looking at some other venues where, again, there's sort of a passport equivalent. So for us, that it's not just the regulator, it's then all the ancillary service providers that provide the plumbing that's important for making this work, including exchanges that also have to play ball. Otherwise, you got a false positive with just the regulator approving it.
You also mentioned something earlier about Bitcoin. I think this might also be an interesting question here in regards to Well, I saw a Medium article by Fineqia that I read, and it talked about yield on Bitcoin being kind of this missing link for, I think, a lot of Bitcoin holders, large and small. Can you touch on that a little bit in terms of maybe the potential here for lowering things like volatility risk, creating a generation of income through yield, as well as maybe the institutional access that that could also provide further to Bitcoin here going into the future, given that it's the primary asset that I think a lot of them are trying to touch?
There's right now, as you know, Bitcoin is not a yield generating asset per se, right? There's some attempts by it, like the likes of Babylon, that are trying to get, but the yields on that are relatively low, and the depth of the pools they can tap into for that is extremely limited. So you can't deploy, hundreds of millions there. There's a limit how much you can go there, and you need something that's much more elastic when it comes to yield generation for a Bitcoin-like product. You get yield on ETH or Solana or Suya or various other Polkadot, various other protocols, because they get staking fees and or which could be gas fees, for example, in ETH, or they could be DeFi yields from lending and borrowing and collateral provisioning. Bitcoin has less of that. So the way Bitcoin generates yield is either by parties like hedge funds trading the volatility of the price. Of course, that's there. And you can come up with an option strategy, like a covered call option strategy that's month-end based. They expire every month and you trade up and down. And you can generate yield from the volatility. The problem with that is that by having a covered call option strategy, you have put a limit on how much upside you get if Bitcoin price goes up. So as we were just saying, these, even in the last month, the market's grown. So on an annualized basis, if you're going to have a cap on let's say BTC's price, because you want to get the yield, you'll be giving up a fair amount of headroom, because chances are the price of Bitcoin will go higher than the yield you're getting. Right? So if Bitcoin goes up 40%, your cap might be 25, 30, 40, maybe 60% of that for maybe some 5, 6, 10% yield. So people would rather just take the asset naked and ride the upside, all the same being exposed to the downside, but they're happy to take that risk because they're long Bitcoin. So you can get yield from the strategy, which is a covered call option. That's one way to do it, but then you're capping your upside on the price movement, which most Bitcoin believers don't want to do. The other way to do it is to deploy them on these protocols like Babylon, which have limited capacity right now, and the yields fairly low, like low single digits. Or you can do it by deploying them on DeFi protocols and taking delta neutral strategies and playing there with that. So we've gone down that path to set up a partnership with a company called Salient, and they have been doing this for a couple of years, a great track record, and they can get yield from DeFi protocols on chain and effectively pass that on to Bitcoin holders. So creating an exchange traded product around that is our ambition, and we want to basically go out with the first yield bearing BTC product that's not getting yield from a activity that has limitations on the upside of Bitcoin. You want to have the possibility of going up, all the same being exposed to the downside, so they take that inherent risk. But if they believe that long term BTC goes up, they don't want to be capped, and we give them that flexibility with yield on top. So it'll really be the first BTC yield product from DeFi in an exchange traded format. And no one's done that to date. The US obviously doesn't even allow it. We have permissions, and we're going to execute on that and deliver that product pretty soon. And for us, that's a bit of a game changer. Now, the third way you can get yield on BTC, and we're exploring that too, with one of our partners called Wave Digital Assets, which is a disclaimer, we are shareholders in their firm, they're shareholders in ours. They have a really clever way of attracting yield for Bitcoin holders, or frankly, even Bitcoin miners, which is by working with parties like corporates or endowments or even states or municipalities to issue bonds where you borrow from the market, the bond market. The collateral is Bitcoin. So if you are, if you wanted to offer a bond and your ABC company in New York and you don't have Bitcoin, guess what? You rent Bitcoin from one of the big miners, the holders of Bitcoin. So you will pay them because you're going to issue a bond and basically raise money, and you're happy to basically pay for the rental of the asset that will be used as a collateral if you don't own it yourself. So there'll be Bitcoin holders that can effectively offer Bitcoin as a collateral for borrowing against by a third party and receiving an interest income for that. And that's another way of getting it. So it's not on chain, it's an off chain provision. and the product that's offered is a fiat currency, traditional finance bond with an ISIN and perhaps a rating and perhaps an insurance wrapper to make it very compelling for traditional finance people who's saying, okay, here's the bond, I get a yield from the Bitcoin collateral. And of course, the differentiator on this product vis-a-vis other products out there is that the investors, the folks who buy into the bond and subscribe to it, will get a share of the upside of Bitcoin. So it's just not a collateral that's holding the value. It's also a reward share on the upside of Bitcoin's price. So if you hold it for 3 years and Bitcoin goes from wherever it is today, call it 100 to 250 or 300 or 500, they get a slice of the upside plus the interest in it. Meanwhile, and the Bitcoin collateral was provided by perhaps a miner or someone else out there who's getting the upside, or at least most of the upside, because that's part of the formula, as well as now a low cost way of borrowing, but still getting yield on the Bitcoin.
Interesting. I'm constantly fascinated by Bitcoin's evolution here, from going from Bitcoin's going to be the currency of the world to it's going to be the store of value of the world and replace gold, to DeFi on Bitcoin, to Bitcoin as or within financial products. It's quite a cool thing to see over time, and definitely has its place.
And actually, one of the themes there, sorry to interrupt you, one of the themes that proof of talk was also the hybrid versions of tokens we're seeing and blockchains we're seeing, such as BitTensor, which basically are combinations of AI and Bitcoin. And to me, that's quite a clever play because, AI is going to make both deployment of Bitcoins and user interface and the user experience much more uh, approachable and tenable for the vast majority of people. Because, if you have to go through crypto stuff today, MetaMask is clunky for people who are used to, apps on their phone. And at the same time, then choosing where to deploy coins and should I go into this protocol or that one, AI just helps you make decisions better, faster, and a more user-friendly fashion, and of course expedites all that. So to me, that's another big trend of one to watch for the 2025 and 26 is this fusion of AI with BTC, in addition to all the things you just mentioned about digital gold value, store value, medium of exchange, et cetera, et cetera.
Yeah, I'm excited to see what more AI is going to be able to do within the Web3 space, because the two technologies between blockchain and AI seem very complementary to each other. And it's been quite a growing trend because people weren't really talking about it until mid to late last year, at least from people I've been talking to, and then it really started to catch on. Everything from decentralized AI to AI within blockchains to make them more seamless or scalable, or finding ways to improve their on-chain functionality, or even from a user side too. So there's been a lot of UI and UX issues in the space, and it's just too complicated for people to interact with Web3, and it's definitely made it a little bit more tangible for a lot of people. So I'm excited to see that continue to change, and hopefully it permissionless as well, because they're very builder centric. I'm sure there's a lot that's going on there too. What about your portfolio? What are some things that maybe you can highlight that are having a big impact today? Maybe direct or indirect, that you guys have there that you find fascinating.
Look, I think our star portfolio companies, Wave Digital Assets, are doing a phenomenal job of uh, building a business that's a crypto asset management business that deploys coins in DeFi. That's why we bring DeFi expertise to our ETF business, because we partner with them. They have done it for many years, probably the longest standing track record when it comes to yield bearing for coins. And they manage treasuries for Cardano, for um, Solana, Sui, Polygon, uh, Filecoin, various other protocols out there. And of course, they come up with clever things like this bond we just talked about, this BTC backed over collateralized bond. So I think that's a great play. We've got indirect exposure to various things like optimism, near, etc., which I think some have done well, some have have been were short on their promise, but it's there. We're working with Cambridge Blockchain Labs out of England, Cambridge University's affiliate, and they have really cool startups access to. One of them is called Interface, which again is a middleware, if you may, between um, DeFi and yield generation and static sites out there. So it's a really cool operating model that's proving itself with likes of ETH and Solana and Dogecoin, for example. So they have um, really smart people building interesting protocols for again bridging the TradFi and non-TradFi world with yield generation. So yeah, we are looking at a number of other things. Frankly, I think for us, our continuing thesis will be more ETPs with innovation behind them, such as when we talk about Bitcoin and some other ones that replicate what we did with Cardano earlier this year and sort of push the envelope further. And then I think this bond instrument is going to be quite appealing because no one's really cracked a Bitcoin-backed bond in the bond market. And as you're aware, the debt markets, the bond markets, are about 3 times the size of equity markets. We're far more familiar with buying stock in Microsoft or MicroStrategy or whatever, MicroFocus, but we have not um, looked at the bond markets. You and I typically are not there. It's mostly institutional. But if you find a way of providing an institutional grade product in the bond market that, again, crosses that chasm for crypto world with a Bitcoin backing, you could really have some explosive on your hands. So I think that's kind of where our energies are focused over the next 6 months.
What else is on your guys' roadmap? I know you mentioned that, being you guys' kind of primary focus here over the next half year or so. But what else is coming up down the line? Do you have any other portfolio investments you're looking at that you can talk about? Any announcements, other ETNs maybe that you guys are looking into? What's on the horizon?
Yeah, so we're looking at a Bitcoin yield product that I mentioned to you before, which will be the first yield-bearing BTC that's BTC ETP that's out there. So an exchange-traded product, which is yield-bearing. With Bitcoin as the underlying asset, we're looking at similar ones for like Solana and Sui and meme coins, and I think that'll be kind of cool. We have been, approached sometimes by companies wanting to collaborate or even something more aggressive than that when it comes to the Bitcoin treasury type play, because there's a lot of companies trying to imitate MicroStrategy or what's now called strategy. Obviously, like the 21 Capital company backed by SoftBank and Cantor Fitzgerald are like examples of that. There's obviously Nakamoto, there's Matador, there's MetaPlanet. There's a whole bunch of companies that are imitating that, which has value. But for us, the real 2 plus 2 or sum of greater of its parts argument is adding the ETP part to a Bitcoin treasury play. So if you're a Bitcoin treasury company today, you would get BTC in your holdings and you get value at a premium to that. So MicroStrategy or Strategy has probably got the lowest premium. They're about 2x the value of the underlying BTC. Someone like Soul Strategy is like more like 8 to 9x. They've been as high as like 18x in the past, and they're using Solana as the underlying collateral. Well, over time that will normalize, because if you look at your traditional finance, private equity world, whenever you have a traded company, the net asset value is, if 100, it's rare for the market cap of that company to be 200 or 300 or 500. It's usually about the same, or quite often at a slight discount, because the underlying portfolio has risk involved and they're illiquid with their private company investments. With something like BTC, it's probably less likely to have a discount because it's liquid, and you can argue that the risk is macroeconomic or black swan events as opposed to anything else. So it'll probably be the same or have some premium, and maybe MicroStrategy strategy is close to where that premium is there for the short term. But over time, that will normalize. That'll come closer to being at par. So if you want to have a play which the market recognizes and rewards you for, you'll need an income stream on your assets, not just holding the assets. And that's where the conversation we had earlier about getting yield from your underlying digital assets becomes really important. So if you have a ETP arm and you combine a treasury play and put the same coins you have in your treasury into an ETP, they still are your assets. They still count as your treasury because they're still yours. You've put them into an ETP wrapper, and that then attracts more flows from the TradFi world, because people see, oh, here's a Bitcoin product getting yield like we're doing now. Well, if I'm a Bitcoin investor, I want to get into Bitcoin. First of all, I'm getting into an ETP that's giving me yield. Second, I don't have to worry about things like custody. I don't have to worry about which DeFi protocols to deploy them, or even staking pools to go in. That's all taken care of by the ETP issuer. And the weird thing is, it's actually cheaper, because if you look at the cost for converting fiat to BTC almost anywhere, it's probably like 2%. If you take a pro account, it might be 1.5%, and you're a professional investor and you have a higher volume. If you do that, the average Joe is probably going to get it for 2%. Whereas ETP fees are at most 2%. They're probably more like 15 bips or 30 bips. As if you look at the US Bitcoin ETFs, their costs are basis points. So you actually get a much better product and a cheaper product. And when the US allows for yield generation beyond their cap, even more exciting. In the meanwhile, Europe has that. So I think this whole move towards treasury management that can over time morph towards ETP issuance could be really clever, because you still have the treasury of your crypto assets. They're not going away. That's still on your balance sheet. In the short term, you get a premium, but you start building revenue streams from ETP fees, which are typically some assets under management fees and performance fees, especially if you're getting yield on them and you're attracting new people, because then you build the AUM for that ETP from TradFi people coming in. So you may seed it with 20 million from your Bitcoin treasury, or let's say 100 million. If that attracts another 5x from traditional investors who are buying it because they're buying a listed security that gives them Bitcoin exposure, yield exposure, no headaches of custody or or staking or DeFi deployment, and ultimately a lower cost than holding it naked, that's a slam dunk. So I think that trend will happen on the kind of TradFi crypto convergence. There's lots I can talk about where I think other things will go. And I guess one thing I should touch on is stablecoins, because obviously I'm involved with this project, which is a project with the co-founder of Tether. We're called stable.com, stbl.com. And really what we're trying to do is, again, going back to the thesis of democratizing financial products. If you look at Tether, they have a great business model and super well-timed business model, right? Especially once they got past some initial regulatory concerns. Not that they're completely devoid of regulatory concerns, there's still some, which is why they are releasing out of the US. But the model they created for utility in the blockchain was great. So when they started, it was very simple. Look, you needed to do transactions on chain. You needed a currency that was stable. So you give Tether 1,000 USD, and Tether gives you 1,000 USDT, and you can use that on chain. Tether takes your 1,000, puts that in their treasury. Over time, that's grown to like north of 150 billion worth of collateral that's deployed, that's used to collateralize the stable coins that are deployed on chain. And that collateral is now used to buy things like US treasuries, T-bills. Like 72% of their own holdings are in T-bills, from which they get yield. So Tether, as you know, and often quoted out there in the market, but many people still don't know, they made more money, or about the same as Goldman Sachs last year, like $13.8 billion. So, why? Because they're taking your money and deploying that and making a yield with the same kind of risk, because a US Treasury bill has the risk of the US government. Your US dollar bill has the risk of the US government. So you're not increasing your risk per se, you're just getting a better yield. So we're saying, look, we can do something better than that. You don't have to bring us a US dollar bill as a collateral. You can actually bring us a treasury, because now it's on chain. You can bring us a tokenized treasury with the yield that comes with it, deposit that on our protocol, which is stbl.com, and we will give you two tokens instead of one. One is a token that is a stable coin, which is the principal value of what you invested, and it's just like Tether, and we're calling that USST, similar to USDT. It's US stable. And that's your principal, fully fungible, freely tradable stablecoin. And you can use that for its utility. And then we strip out the yield that you have from the underlying asset, i.e., a T-bill in this case, call it a 5% yield. And we give you a yield token, which we call YLD, and that you can put in your vault, and you can get your yield at the point of maturity of the underlying asset you purchase. So you have agency in terms of what asset you bring, as long as it's within a certain set of accredited assets that we will take on board, such as T-bills or money market funds. And then we give you the yield from it. Obviously, we take a bit of that as our operating business model, but you get the vast majority of the yield and you get the utility. And to us, that's a way of creating a better, fairer, and a collaborative model for a stablecoin infrastructure, rather than just the utility of a USDT or USDC. So I think that is an innovative play in the stablecoin world, where, as you know, it's probably the best use case for blockchain today. Some are calling it the killer app, but it certainly is by far one thing that I hear talked about at both crypto conferences and non-crypto conferences, because it's people understand that, right? They understand a stable coin because the value doesn't fluctuate. It's pegged to a fiat currency. I can transact. It's like trading a digital dollar or digital pound or euro, what have you. So we're entering that space with ours. We announced it in February. We go live at the end of June, and we will, we'll build that out to create yet one more offering in the market that's part of our thesis of being innovative and better for the end customer.
It's exciting. It sounds like you guys are working on quite a lot. Where can people go to keep up with everything? Is the website the best place to go? I know you guys have a Medium blog, socials. Where do you put out a lot of your updates?
Yeah, we put a lot on our blog site, our webpage, Fineqia.com. We have Instagram page. We have LinkedIn posts that are probably the most used by non-crypto people and crypto people like, but certainly TradFi. And then we have, Sky, whatever Blue Sky, whatever channel, and we have with the Sky Blue. It's the other alternative social media platform, and we have a Twitter handle. So so we're on Fineqia or Fineqia platform on various social media sites, and similarly for Stable is STBL or STBL official for our Twitter and or Instagram channels out there, and of course there's Medium and Discord as well.
I imagine education and networking is a big part of this behind the scenes as well. Obviously, you're at Proof of Talk right now. Any other events or conferences or engagements later this year that you guys plan to be at?
Yeah, I think the conference now come in two stripes. One is fast, big ones where everyone's there, but you are in a bit of a fish market with 3 events that you want to be at happening at the same time, competing for your attention. And I'd put like Consensus and Token 2049 in those categories. They're very valuable. They're also very big. You have to be really, really specific about who you want to meet and target if you've not met them before, because you can get lost in the noise. And then there are more specific, smaller, curated events like Proof of Talk here, Satoshi Roundtable in Dubai. There's the Salini Summit in South France. There's CFC Morts in Switzerland around the time of Davos. So I think those 2 categories is where you want to choose where you want to be or be in both, but be really cognizant of what you're going to get from it. So for us, I think Satoshi Roundtable has been great. Obviously, both Token and Consensus in their own ways have been great. Proof of Talk's great. I think Salini Summit's a great one this year. And then there's some more niche ones, like Medici Summit is also a good one. And there's an Istanbul Blockchain Week coming up end of June, and ETC around the same time. So if you want to go to new markets, then something like Istanbul Blockchain Week is going to be good because they also have like a really high adoption of stablecoins and Bitcoin. And if you want on the dev side, then something like an ETC is obviously a good one to go to. I find like a lot of the growth, and if you talk to the big exchanges, they're looking for more users, more growth. And one thing that we bring as Fineqia is access to TradFi investors, and we also access new geographies. So I think a lot of the uptake, not necessarily in buying Bitcoin, but understanding crypto-based models or blockchain-based innovation, has largely been Western-driven, right? It's a developed economy. And what you're finding now is a lot of the users coming on board, especially as they get exposed to not just Bitcoin, but stablecoins, are from the rest of the world. So if new users are going to come on chain and they're going to be participating in sexes and dexes and the next set of investors that people want to attract, whether it's to projects or whether it's to a Binance or Coinbase type or Kraken-like exchange, they're going to come from TradFi and new economies that are coming on chain, whether it's Vietnam or India or Indonesia or Kenya. So we want to be that bridge to get there. And there I find we'll see interesting new conferences that are coming up. Istanbul Blockchain Week is sort of an example of that, but they're already fairly advanced. But you'll see more coming up in new jurisdictions, and I think those are the ones we go to, but that's where the greenfield opportunities lie.
Yeah, I like the smaller events and meetups the most. I just feel like there's a lot better networking and alpha that usually comes out of that kind of stuff, just because the big ones now are so overly commercialized, and they have their place, and there's nothing wrong with it. But it's so much noise. NFT NYC, Token 2049, Bitcoin 2025 in Vegas. They're so big. It's hard to get anyone's attention, but. Yeah, feel you on that. I bet Proof of Talk is really nice too. That one's been going well, right?
Yeah, for sure, for sure. Yeah, and I'd love to hear your thoughts after you attend permissionless and see how where that fits in this on the spectrum.
Yeah, 100%. Permissionless has always been a little bit more builder centric, so you get a little bit of a different crowd, and it's not like overly big to the point where you can't like interact with anybody. So that's why I like to go to that one. But it's also just again different crowd. You go to different meetups, different events, and you kind of get different people within the space doing different things, and it's kind of nice to see what people are doing under the hood as much as what they're doing on top of everything, and kind of get a good, well-rounded understanding of the space. So I'll let you know for sure what I see when I'm there. But Bundeep, this has been a really good episode. Really enjoyed the conversation and what you guys are doing with Fineqia. Keep up the great work. We'll put all the links and everything in the description for the episode below, so everyone can find everything very easily. If anyone wants to get in contact with you directly, maybe they want to work with you on something or Fineqia, what's the best way to do so? Is that maybe through LinkedIn or other place on social or?
Yeah, LinkedIn is great. That's fine. My first name is fairly unique, so you'll find me on Twitter and LinkedIn and Instagram for that matter. And there's also obviously contact at fineqia.com. It comes through, and that's a pretty straightforward one for people to just drop an email, and we can always follow up from there.
Awesome. Bundeep, again, been really great conversation. Looking forward to talking to you again soon. Maybe we can meet up at some point in person. Love to do an episode follow up. I know you guys got a lot coming up on your guys' roadmap, so I'm sure there'll be plenty that we can talk about here in the near future as well. So, but appreciate it. Enjoy the rest of Proof of Talk and take care. And we'll be in touch.
Thank you so much. Appreciate it, and then hopefully see you soon.